Hi everyone. Good evening participants. Welcome to the Q4 and full year FY2024 earnings call of Eclerx Services Limited. Please note that this webinar will be recorded. To take us through the results and to answer your questions, we have with us the top management of Eclerx, represented by Kapil Jain, Managing Director and Group CEO, P.D. Mundra, Co-founder and Executive Director, Anjan Malik, Co-founder and Director, Srinivasan Nadadu, Chief Financial Officer. We will start the call with brief opening remarks by Kapil, followed by Srinivasan. After that, Kapil will take us through the strategy for the firm, and then we will open the floor for Q&A. As usual, I would like to remind you that anything that is said on this call that gives any outlook for the future, or which can be construed as forward-looking statement, must be viewed in conjunction with the risks and uncertainties that it face. This risk and uncertainties are included, but not limited to what we have mentioned in the prospectus filed with the SEBI and subsequent annual reports, which you can find on our website. Having said that, I will now hand over the floor to Kapil. Over to you, Kapil.
Thank you, Asha, and good evening, everyone. Let me start by giving you some highlights of our performance in FY24 Q4 and for the full year. We delivered a revenue growth in USD terms of 1.5% quarter-on-quarter in Q4, reaching operating revenue of 91.9 million, driven by growth in our customer operations and financial markets business. This is a strong performance, bearing in mind the slowdown in developed markets and the loss of one of our large clients in Personal, whose revenue had to be replaced in this quarter. For the full year, our revenue in USD terms grew by 6.4% year-on-year to 353.9 million, exceeding the industry average. In INR terms, operating revenue for Q4 was 7,665 million, up 1.8% quarter-on-quarter, and 29,255 million for the full year, up 10.5% over FY23. There is a sequential decline in margin in this quarter, primarily owing to our investments in strengthening our sales and delivery capabilities. For the full year, we delivered a EBITDA of 28.1%. Net profit for FY24 was up 5.1% to 5,115 million. As with the previous few quarters, growth this quarter has been led by our customer operations and our financial markets business. We have seen exceptional growth in our large clients in these businesses. Our BPaaS business has grown by 4% year-on-year to 86 million. This has primarily come from financial markets business. Our analytics and automation business at 65 million has shown an 8% year-on-year decline because of business challenges faced by some of our clients and reduction in discretionary spending. New deal ACV for the year was 91 million, up 10% from FY23, which was at 82 million. Our pipeline is healthy across all three businesses as we get into FY24-25. I'd like to give some commentary around our three businesses: financial markets, CO, and digital. Financial markets and CO had a good Q4. We saw a strong demand around our compliance offerings, client lifecycle management from several clients. We also saw an increase in the transaction volumes, and we have also started providing our KYC compliance services out of our delivery center in US. The customer operation business showed strong quarter-on-quarter growth driven by existing clients, and some of the growth was due to high transaction volumes driven by seasonality and supporting key client strategic initiatives, which required us to ramp up and ramp down on a very short notice, and we are well equipped to meet that demand from the clients. Digital, it was a soft quarter for digital, with clients starting slowly with their 2024 budget allocations and renewals. We expect momentum to pick up a little bit in Q1, but overall environment continues to be cautious for the digital business. Many of you would be interested in knowing what we are doing on Gen AI, as I have spoken in a few previous quarterly earnings call as well, and I'd like to cover it briefly. We continue to have discussions and pilots with several clients, primarily around content operations, care ops, and insights on demand. In content operations, for example, we are helping clients generate automated content, image, audio, and video in insights, the work is mainly on generating real-time insights and data analysis using conversational bots to query across structured and unstructured data sets. GenAI is also embedded in our tools, such as Compliance Manager for KYC, Market 360 for digital shelf analytics, and Tech 360 for field tech operations. We welcome 3 senior leaders in the markets. Manish Sharma has joined us as a Chief Revenue Officer based in New York. Manish has an impressive track record of driving growth, winning strategic deals, and enhancing client relationships. He will play a pivotal role in driving our growth agenda and expanding our capabilities. Carolina has joined us as the Chief Marketing Officer. She is based out of New York and will be responsible for the overall development and execution of the global brand, marketing and PR strategy. She has spent over 20 years in B2B marketing and brings a wealth of experience from large global enterprises. Michael Hutchison has joined us as a leader in our customer operations business. In his career, Michael has demonstrated exceptional leadership, strategic oversight, and innovation. At Eclerx, Michael will oversee the customer operations client portfolio with a focus on sustaining organic growth and fostering new client acquisition. As you would see that we had 3 senior leaders in the market. With the addition of these 3 senior leaders and me also sitting in the market, we have expanded our leadership presence in the markets to 7. We'll continue to invest in sales and delivery capability. We are also taking up additional space in 3 cities we operate. These investments will result in an impact of about 400 pips to EBITDA. So we are revising the range for full year EBITDA to 24 to 28%. Additionally, I'd like to touch upon recent recognitions we have received. Our AI-powered digital shelf analytics platform, Market 360, was awarded bronze at the e-commerce Germany Awards for Best Analytics and BI Solution. We also won 2 Gold Asia Pacific Stevie Awards, one for innovation in human resources management, planning and practice, and the second for innovative use of technology in human resources. These awards are a testament to our focus on knowledge management and innovative use of technology. Finally, I'd like to thank all our clients for their business and their confidence in us. I'd also like to thank my senior leadership team and all the employees of Eclerx for their relentless focus on execution and client centricity. Thank you. Now I'll hand it over to Srini, who will give more details on financial performance.
Thank you, Kapil. Hello, everyone. I hope I'm audible and clear. I will take you through a little more detail on financial performance for Q4 and the year. As Kapil mentioned, operating revenue was 91.9 million. Sequentially, revenue grew 1.5% in USD terms, 1.4% in constant currency terms. Operating revenue was up 6.4% in USD terms and 5.9% in constant currency terms. Total revenue for Q4 was 7,896 million, up 2.1% sequentially. Full year total INR revenue was 29,910 million, up 10.2% over FY2023. Coming to margin metrics, full year EBITDA was 8,403 million, up 3.8%, while full year PAT was 5,115 million, up 4.6 million. Other income was 230 million, mostly due to higher investable surplus that we had. On delivery costs and S&D costs, so if you recall our commentary in the last earnings call, we had mentioned a reclass of about 90 bits from delivery to S&D. Now, if you really take that out and you factor in the impact of the reclass, an apples to apples comparison of Q3 versus Q4 is that S&D is not flat, but it is actually up 90 bits. And delivery costs are not up 160 bits, but they are up by about 70 bits. Both these increases are because of investment to strengthen our teams in delivery and in the onshore business development teams. There is a 50 bits increase in G&A, primarily because of an increase in license and subscription costs and also in employee transport costs. On the key business metrics line, top 10 client concentration has gone up, partly because of the roll-off of the client in personnel, which was outside the top 10, and partly because of the strong growth in existing clients in customer operations and financial markets. The seat count has reduced because we gave up an office in our location. But as Kapil mentioned, we will be adding seats in Mumbai, Pune, and Chandigarh over the next few months, and the seat count will increase. DSO is about 84 days, higher than the previous quarter, but in line with Q4 of last year. Exit headcount is up by about 270 people over the previous quarter, while attrition is up from 16% to 22%. It is still some way away from the range that we usually operated in. We have about 1,100 crores of cash on our books, and in line with the usual practice of returning excess cash to shareholders, we have announced a buyback of rupees 385 crore and a dividend of rupees 1, subject to shareholder approvals. A couple of facility-related updates. We have opened a new office in Switzerland to be able to serve clients in that geography. I have also mentioned that we are adding space in Mumbai, Pune, and Chandigarh, and these additional spaces go live in about 6 months. And finally, just to conclude, I would like to touch upon our work in the areas of CSR and ESG. So as part of the CSR program, we partnered with Sampark to support education, employability, and skill development for tribal communities. Over 3,800 children and youth have been the beneficiaries of this program. Through our partnership with Lighthouse Communities Foundation, we help provide foundational and vocational skills to about 2,000 people from marginalized sections. We also continue to make progress on ESG initiatives. Across our India offices, the share of electricity from renewable sources has increased from 32% to 68% over the last year. And we have been awarded the bronze medal by EcoVadis, which places us in the top 35% of sustainability reporting across 1,000 plus companies. Thank you, everyone. With this, I conclude my prepared remarks. I'm sure many of you are keen to hear about the firm's strategy. So I will hand it over back to Kapil. He will take about, I guess, 20-25 minutes to share his strategy for the firm, and after that, we will open the floor for questions. Thank you, Jimmy. Let me just.
Thanks. So I think a lot of you have asked me this question in the previous earnings call, and it's almost a year since I took over this role. And in the last 12 months, I have met several clients, have visited all our delivery centers, have touched upon almost 70-80% of our employees. And I think from whatever I have gathered and seen, is that a very strong client roster, very strong delivery capability, tech-enabled, our ability to bring in technology and amplify human potential is very, very high. And we are at an inflection point, which is where the board, I think, thought that from a founder, professional founder, let's get a professional CEO. And the charter that I was given was accelerate growth. And when I started looking at the data, and historical data, we have had impressive losses over the last 5 years. We had industry-leading margins in our KPO, BPO, IT, ITS industry. We had marquee client list and great client references. 80% of our business comes from client referenceability, client moving from client organization A to B, and then they say these guys did a great job, so let's call them over and have them deliver this work for us. INPS ratings. I quote unquote, I'll give you some client quotes like that. You guys are no nonsense guy, but whatever you guys promise, you deliver. We have 3 distinct businesses as we covered in the initial commentary: financial markets, customer operations, and digital. And the buyer in all these 3 business segments are different. In digital business, predominantly we are selling to CMO and CPO. In customer operations business, we are selling to the experience, offset, and in the financial markets business, it's compliance, operations, spec, change are the stakeholders that we sell to. We have a strong team onshore and offshore, and our sales are consultative-led. We have onshore delivery centers, onshore consultants who are built. And I think we have a strong client-centric problem-solving culture. Because I ask people who have been with Eclerx for 10 years, 15 years, that what has made you stay in the company? And single-minded focus on client. And the founders believe that if clients have given us the work, it's our moral responsibility to deliver on whatever commitment we have made. We have very strong deep domain. I think I'm the only journalist. Every one of my direct reports bring in very strong domain to the point that they can actually have a very meaningful discussion with the client and very strong delivery, as I mentioned. And our entire book has a sliver of technology enablement. It's not that we are a tech company, but anything we do in ops, be it in terms of learning management tool, be it in terms of training people, be it in terms of looking at data, looking at to see how do we automate, eliminate, and enhance the overall experience. Now, the question you'll ask is, if everything is so good, then where are the opportunities? And I felt that there needs to be a much more sharper focus on sales, because you could only grow up to a certain point if you continue on the referenceability. So we need to create a new muscle and new drivers for growth. We need to increase risk appetite in terms of what we can do and how do we build use cases that we have delivered in a certain industry, and how do we see relevance of those in another industry segments or in adjacent areas. How do we bring predictability of revenue in terms of growing top 10 outside of that? How do we add new clients and grow existing clients? Because as you all know, we have a very good client roster, referenceable clients, and there is a huge opportunity, untapped opportunity and potential to grow those set of clients. And how do we deliver a common and consistent market messaging of one Eclerx? I think many of the stakeholders I met, I think sort of were confused that what does Eclerx do, what do we stand for, and how we would want to position ourselves, and how do we come together, right? We have three businesses, but there are a lot of commonalities across the three businesses, and what is the narrative we want to send to the market? Let's move to the next slide. I think our 4-year aspirations are that we want to be in the top quadrant on growth and industry-leading margins. Our positioning would be on one Eclerx, and we want to be preferred service provider for global clients across 4 key industries: financial markets, high-tech, retail, and cable and telco. We want to focus on cross-selling and filling white spaces in existing clients. Like I mentioned, there is a lot of untapped potential in our existing clients. Moving in adjacent areas as well as moving into new areas as well. Execute multi-year deals with repeatable annuity revenue and also focus on new revenues in certain business segments. I think our unique value proposition is productized service delivery, and by that I mean is where you are able to bring in technology and domain together to amplify the overall experience, efficiency, effectiveness. And on people and delivery, how do we bring in the growth mindset? I think we have very good capability, a good client roster. How do we bring the growth mindset and take it forward? Invest in senior management and institute a learning and innovative culture, and promote collaboration across the 3 businesses, and promote entrepreneurship and our risk-taking ability, which I mentioned in the previous slide as well. Let's move to the next slide. So, having said all this, what does it mean? What it means is that we want to dominate profitable service niches and across core industries. And why we have chosen this as an approach? It gives a focus that we will do a few things that we will do extremely well. We look at adjacencies. We will utilize full share of wallet in existing clients and pursue new clients and geos. So, for example, if MarTech, we have a presence in APAC and we have been able to grow, US being the largest market, how do I take MarTech in the US market, which is the biggest market? Then we assess what are the capabilities required to deliver on the growth strategy. And we said that you need client sponsor management, strong client referencing, you need large sales hunting teams, and also build capabilities in adjacent areas. And the reason we felt that the advantages for going with this strategy is that it will take less time to build capabilities, so we'll have a better time to market. We will piggyback on existing referenceable clients. 80% of our business comes through referenceability. We will go deeper as well as look at in terms of if you are doing run the bank where I'm doing change, can I look at the change or look at technology projects and leverage our tech assets, which I'll cover shortly across the three businesses. Now, what are the risks associated? As you know that there is a revenue concentration across volatile industries because the retail financial markets have higher volatility than some of the evergreen industries. But our portfolio and balanced portfolio allows us to manage that risk. And obviously, we want to gain market share, so there will be some pricing pressure on the deals. Because my view always has been if the deal, you lose a deal, you lose the deal forever. So I think we need to be competitive and see how do we deliver, and market will determine the price at which we will win the deals. Now, I'll also cover briefly what it means for each of our business segments. For financial markets, we've increased the wallet share in existing clients because we do feel we have very good client roster, good delivery, and hence looking at adjacent areas in existing clients is an opportunity for us. And we will look at both run the bank and change the bank. We've had some small success in these areas, and we want to see how do we grow on that vector. We'll also look at new buying segments for our key capabilities, which is client lifecycle and trade lifecycle. These are two productized services we have. If you look at digital, again, we have a large roster of clients. The focus would be to pick and choose and look at increasing the wallet share and also focus on 4 key industries: high-tech, retail, manufacturing, luxury, and fashion. On customer operations, I think we have 4 core services: chat, voice, ADR, logistics, dispatch, and quality. And we need to offer disruptive proposals to gain new logos market share, as well as look at new delivery centers and evaluate nearshore options based on the client demand. Now, if you look at the underlying theme, tech-enabled services, and we have only highlighted the key technology differentiators here. This is not an exhaustive list. So in financial markets, the 2 key products that we use is one is the compliance manager, which is the KYC managed services that utilizes cognitive technology and efficient processes to reduce cost, manage risk, as well as ensure timely adherence by our clients. And it gets data feeds from Dun & Bradstreet and Rex's Nexus. Doc Intel is leveraged for digitizing complex documents for data extraction, analytics, for structured loans, drafting and feeding downstream systems. On the digital side, Market 360 is real-time insights on digital shelf, enabling retailers to make data-driven decisions, insights, products out of stock, competitive intelligence. Merchandising Plus allows companies to launch new products and accelerates it takes time to launch the new products through GenAI infused data aggregation, product builds, and data flows. On the CO side, as I said, quality I mentioned is one of the key service areas that we have. A GenAI powered quality evaluation platform to analyze agent behavior, compliance adherence, and conversation sentiment. And the Tech 360 is predictive dialing platform that we have to manage customer interaction journey with real-time assist capabilities for both voice and chat. So like I said, these are key products that we have, and it's not that these are the products they are sitting on our shelf. These products are deployed with our marquee clients that we currently service. To the next slide. I think these are the 3 focus areas to deliver on the strategy. One is strengthen our sales operations, more rigor, pipeline review, pipeline management, account management, optimizing sales headcount and utilization, strengthening the governance process, focusing on tech sales, which can help us drive our automation and analytics sales, continue to invest in sales and marketing. The ones that are in bold are the ones where we have already made progress and delivered on the same. The ones that are on not bold are the ones that we will be working towards. Mining existing clients and winning new logos you saw was the strategy that we laid out in terms of building adjacent capabilities, generating and billing large deals. We have put 2 million ACV, which is about 10 million in TCV if you are looking at 5-year deal term. How do we build integrated solutions and increase the overall size of the deal? Double the pipeline. Cross sales, taking our while I mentioned we have 3 businesses, but some of it has capability, the verticals that we service. So there is an opportunity for us to cross-sell some of our capabilities into new verticals. And we'll continue to lead with tech and analytics differentiation that we have. In terms of enhancing our positioning, we have already onboarded Caroline, our CFO. We will build tech partnerships and alliances, establish our GenAI proposition, and also leverage the analyst and advisor community, which we have not done in the past. So this is for FY25, the key focus areas. For FY26 and 27, we expect to pivot by industry and capabilities and drive more top growth as well as bottom line growth behavior through a better and more rigorous performance management system. We'll add multiple channels of lead generation, which will help us double the pipeline. And our aspiration is to be featured as leaders in analyst rankings and also continue to productize our service offerings. And FY28 is continue to focus on sustainable growth, strong margins, bring more predictability, and as well as continue to invest in our leadership development and succession planning. And underpinning all this is to continue to deliver on our robust delivery and strong margin governance. So I'll take a pause here. I think this was the last slide, and I'll hand it over to Asha for the next set of.
Thank you, Kapil. We'll start the presentation now. Wait for a moment. People who is having a question, please raise your hands to ask the questions. So we have first question from the line of Nikhil Chaudhary, who is from Goa. Please go ahead and go ahead.
Hey, hi Kapil, hi team. Thanks for the opportunity. My first question is regarding a possible outcome from the investment we are doing and how long we plan to do this investment. So Kapil, you highlighted the new margin guidance and some of the new opportunity as well as capability you are trying to tap in, as well as delivery centers we are trying to develop. So any comment on how long we are planning to do that? So timeline in terms of when basically this heightened investment phase will be over, and anything in terms of quantifying the impact on growth?
So I think in terms of sales and marketing, we will continue to invest, right? We are running business and we'll continue to invest. And in terms of capabilities in adjacent areas also, we will be building those capabilities. And like I said, we have given the margin guidance and we will stay within that range. And we will keep a close watch in terms of the growth. Our entry pipeline is strong, and that's all I can say at this time.
Sure, Kapil. In terms of the capability and investment, can you please help us understand how much is going towards building capability? Some of the product you mentioned do have generative AI capability. So anything incremental we did in this area, especially positioning ourselves as a leader in this category?
So see, this is a real-time business and very hands-on business that we operate for our clients, right? In terms of the services that we offer, these are critical core ops change program that we deliver. So I think whatever is required to stay relevant, capture market share, continue to drive high performance culture, and continue to invest in growth, technology, analytics, automation is what we will do. To quantify specifics in terms of what will be in this area, that area, I think we'd rather not give that because that would be a function of the outcome that we are able to deliver. And the range that we have given is the range that we have given, taking into account the investments we will be making in all these.
Sure, Kapil. Just the last point from my side. One of the point you have mentioned is having the higher risk appetite, right? Can you give us some example how basically Eclerx will change as a company, especially from risk appetite perspective, maybe targeting different clients? So any example in that area?
So I'll give you an example, right? We were doing for one of the clients, we were running ops business and they wanted to build some technology products. And initially we thought that that's, we have never done it, so it's an uphill task. But then collectively to put our heads together, because we have strong domain process tech capability, the clients were building on Microsoft Azure and we had capability on tech ops we were anyway doing. And we put together a cross-functional team and we are executing well on that project. Now, if we were too conservative and we didn't want to take the risk, we would have said no, which would have been an easier answer. But I think by doing some of these projects, we will get greater confidence and then we will double down on the same.
Sure, Kapil. Thanks a lot and good luck for coming period. Thank you.
Thank you, Nikhil. Next question comes from the line of Dipesh Mehta. He is from FA Global. Dipesh, please go ahead.
Yeah, thanks for the opportunity. A couple of questions. First, about the margin. If I look the margin guidance, if I understand correctly, 24 to 28 is for only 25 or it is for 4-year kind of journey? That is first question. And in that, after investment phase, how you expect margin trajectory to play out, considering growth is accelerating based on the investment and it started getting result from those investment from growth acceleration perspective. Second question was M&A. I think you have not touched upon M&A focus. So if you can provide some color about your overall strategy, including M&A, if it fits into strategy or it is largely organic kind of thing. Then I have a couple of questions from additional data point which you said in this quarter's presentation, the ACV data which you said excluding CLX. If you can help us understand how to read it, because the revenue growth and ACV trajectory seems to be not going good hand in hand. So if you can help us understand based on your understanding how to read the ACV data. Thanks.
So I will cover first of the questions. So the 24 to 28% Dipesh is our estimate for this year, FY25. Based on how the investments progress and what results we see out of them, I think towards the end of the year, we will see that the range has to be revised, either upward, hopefully it doesn't happen, downwards. The second question you had was on I think one question you had on M&A, so I'll Kapil speak to that. But let me answer your third question. The ACV of new deals is basically for every deal that we sign, and this is new deals only, not renewals. What is the annual value of that contract? So if it is a multi-year contract, we will still take the revenue that we expect in year one. And if it is a short-term contract, let's say it's 3 months or 6 months, then we will take the value of that for the period of that contract, which means in this example, 3 months or 6 months. And that's what it is. We have excluded CLX because they use a different system to monitor deals, and that doesn't flow into us. In any case, a lot of the CLX business is very project based, and a lot of it needs to be resold every year. If you have any specific questions on the numbers themselves, I can answer. Otherwise, Kapil, you want to talk about?
Yeah, I will. So I think you had also asked a question, and I really covered it. The margin guidance that we have given 24 to 28 is for FY25, and we will keep a very close watch and monitor it closely, growth and the margins that we are delivering. Like I said, it's a real-time business that we are in, and we have already laid out a very strong governance process to manage both the top line and bottom line. On the M&A, yes, that continues to be our strategy. We would be looking at areas where we bring in complementarity, and that also helps us on our capability access. So that's what we will continue, and we have a dedicated person who's looking at outbound as well as inbound M&A targets.
Couple of follow-up, if I can. First about the margin, 24 to 28 is roughly 400 bps lower than what the previous year margin guidance range was. Now it is a significant investment in a way if you look in isolation. Considering the investment in 25, do you expect the range, how long it will take for us to be the prior range?
It is hard to answer that question. I think it depends on how soon we get results out of it.
So I think, like I said, in terms of we are giving the guidance on the EBITDA margin for FY25, and as we get closer, as our investments started to yield results, as I had mentioned, from 3 senior leaders we have in the market, we have doubled down, and now it's 6 and 7, including me. I'm also based out of London. I think with all these assets in place, we will continue to invest. So I think we will, as and when we have visibility, we will share the same with you.
Just on the ACV data, which you said renewal is not part of it. Am I right in understanding it?
That's right.
So it is only net new which is you included, and even from existing client, if some additional business, we have covered it or no?
So, new business from existing clients, it is included in it.
Understand. And last question is about M&A. I think you indicated complementary area and capability driven. Can you help us understand the area where you intend to expand capabilities and where you look M&A to expand capacity and reach in next 2-3 years? Thanks.
So I think, as we have 3 distinct businesses: financial markets, customer operations, and digital. So these are the areas, and like I said, on the market side, for example, in digital, we have a strong presence in APAC. We are looking to expand in the US. So depending upon in terms of capabilities, in financial markets, we have 2 distinct capabilities: client life cycle, trade life cycle. We are predominantly sold client life cycle in financial markets business, so the relevance of it could be in other industry segments also. And hence, those are the adjacent areas like governance, risk, and compliance is where we are tapping upon. So when I say synergies, it's like the client stakeholders we are selling to more of us, or the capability that we have, where we can bring in a differentiation from our tech and product life services. I would want to share specific areas that look this. If you know, like in terms of our customer operations, we have 4 product life services. In financial markets, we predominantly have 2, and then in MarTech, in the digital side, we have 4 distinct, and we continue to look at adjacencies in these areas.
Understand. Thank you.
Thank you, Divesh. Next question we have from the line of Ayush Rasudi. He's from Lindsay Security. Ayush, please go ahead.
Yeah, hi. Thank you so much. So just a couple of questions from my side. So first is, like we are doing a great amount of investment. So is it fair to assume that 1H would be kind of over with the investments, and 2H should be kind of a growth heavy, a part of the business because we would be done with the investments? Then the second part towards margin, I would like to understand with the wage hike coming in 1Q and the investments that are still ahead of us. So fair to assume that from 2Q onwards, we would be back onto the margin expansion story, or will it be totally driven by the 2H in terms of both growth and margin expansion?
I'll take the margin question. So you are right, Ayush. So there will be wage hikes in Q1. And if you look at our history, then every year Q1 is our year the weakest one. As we go through Q4, that percentage increase. That happens even, if whether there is growth or whether there is high growth or less growth. And that you can expect even in this year. So you would expect that Q1 will be the year of the lowest margin, predominantly because of wage hikes and the full impact of the investments that we are doing in that we've done in Q4, that hit in Q1, and any additional investments that we might do. Kapil, you want to take the question on?
Yeah, so I think typically we see in sales that there is a 6 to 9 months of lag from the time you make an investment. So you're right, H2 should start seeing the result. But I think we'll continue to make investments because this is an ongoing business. So it's not that you make an investment and you stop, because then you will only see the runway at that point. Leadership investments, yes, we have made. We would be very selective in making leadership investments. However, we continue to expand the sales and hunting organization and the engine that we have built, as well as on the capability side. So that's the thinking that we have at this point in time.
Sure. So fair to assume that we would be kind of, aspiring to reach for the double-digit growth for FY25?
Absolutely, aspiration. Why wouldn't we aspire for double-digit? Our aspirations are high, so.
Correct. And just the last one, so on just in terms of capabilities that we are building, so just wanted to understand what sort of capabilities are we looking forward for the Gen AI on our for our business, and what type of partnerships are we looking forward towards building the Gen AI capabilities, and how are we driving the revenues at present and going forward?
So first of all, I think what we are looking for is, you saw the products that I laid out on each of our business segments. So first and foremost is our strategy and thinking is to bring Gen AI and make our products Gen AI enabled. So that is the first approach we're taking. In high tech as well as in industrial segment, we are having conversations with the clients on doing pilots on Gen AI. We have created a workbench. So that's really what we are doing. We are also looking at creating a client advisory council. We are looking to invest and continue to build capabilities in terms of, see, it's not like you hire 5 people and Gen AI capability will come. The question is, how do we make people that we have who are doing client operations, and how do we make tech Gen AI enabled? And we have strong learning and development program that we continue to invest in. What was the second question you had? Sorry, you had asked follow-up question also on this.
So for on Gen AI, how are we tracking the revenues, or when we'll be kind of expecting the revenues to commence and from the Gen AI specifically?
So I think we don't see our unique advantage that we bring in is bringing technology and human in the loop and really amplify the human potential. As I told you, we were able to meet client-specific strategic initiatives, because I can train a guy and get him or her up and running in 7 days because of the simulated learning platform that I have. So in there, we will bring in GenAI. The point I'm trying to make is it's not that we are tracking GenAI revenues separately, tech revenue separately. Our unique differentiation is to bring technology, domain, and ops together. And that very few companies can do, and we'll continue to work and deliver on that. In fact, we are investing on the sales side in the technology, on the tech, GenAI, automation and analytics to drive the growth in investment.
Sure. And if I can go ahead with the last one on margins again. So just wanted to understand in terms of subcontracting costs. So consistently, if we see for the last 3 quarters, we have been into the range of 2.1, 2.3, and this quarter it's 2.5. So how should we build in, like, for the next year? Are we kind of relying more on subcontracting? And what are the margin levels that we see from 2Q if we are seeing 1Q as a bottom for the margins? Thank you.
Subcontracting cost should remain in the same range between 2.5. I think it depends on specifically in every quarter, it depends on what kind of search volume that we get, what kind of projects, short-term projects that we get, which we need to ramp up in a very short period of time. So if those kind of situations arise, then we have to engage subcontractors. I think the range is fairly narrow. To your second question on margin, I think usually we see an impact of about 300 bps, 350 bps on Q1 margins because of the impact of wage hikes. And after that, the margins go up back to their original levels. And we expect that to happen with Q1 as well.
My question was, what are the margin levels that we are seeing in from 2Q if we are having the 1Q as a bottom?
Okay, right. So there are 2 levers that we usually have. One is the growth. So that is the fundamental lever for improving margins. We made a lot of investments on the delivery side. So we've hired senior folks, and if revenue were to kick in, that will help add, that will help improve the margin, because then we will add people to execute at the bottom. The second lever, as for most companies in our industry, tends to be attrition. So typically we see attrition as being high in Q2 because people get their wage increments and then they decide to move on if they are not happy with the increments that they have received. So that is an additional.
Thank you.
Thank you, Ayush. Next question comes from the line of Sandeep Shah. He is from Eclerx. Sandeep, please go ahead.
Yeah, thanks. Thanks for the opportunity. Just the first question is the definition of margin guidance is including the other income, right? We have to relate to the 28.1% which we have reported for FY 2024, right?
That's correct.
Okay. So this looks like a very big investment. Can you quantify which area the bulk of the investment will go into? Will it be in sales and marketing? Will it be in leadership augmentation? Because I believe leadership augmentation is largely done and over, and capability. And also, Kapil, you have also mentioned you will not shy away to provide a billing rate discount if the deal win is very large. So can you quantify the investment in these 4 areas, how this will look like in terms of investing for the growth?
So thanks, Sandeep. So Sandeep, like you're right, the leadership hiring that we have done, like the CRO, the CMO on the customer operations side. So that's done. We will do very selective leadership if at all. Bulk of the investments would be in amplifying the sales and hunting team, right? We have a lot of people who are good at farming, so we would be amplifying the hunting team. So that's one area where the investments will go. On a deal by deal basis, it will depend upon if the deal is opportunistic, if it helps add a capability. So it's difficult to quantify. It's not like a war chest or a kitty we have kept that this is for winning deals, this is for this, this is for this. Like I said, we are in a real-time business where you have to make some of these decisions on a real-time basis, and that's what we will continue to do. And we have already incorporated a strong governance process, and that will allow us to manage this and deliver the growth and the margins to the street in line with the guidance that we've given.
Understand, Kapil. So why I'm asking is, what we have said is, if the investment does not yield the required result in terms of growth acceleration, then we may relook our margin guidance. The way I understand is, in IT and BPO being a competitive business, once you invest and lose the margin, it could be a permanent loss rather than a recoup at a later stage. So what's your comment regarding this? Why I'm asking again is, if FY22, if you look at the reported margins were 32%. In FY24, it has already gone to 28%. And from 28 at the lower end of the band, we are looking at 24%. That is a further dilution of 400. That also makes us believe that the management is not happy with the growth aspirations or the target, which we have done well versus market, but we want to further redo it. So what gives us confidence this time that this further 400 bips margin dilution will take us to the growth aspiration where we want to go?
So 2 or 3 things, Sandeep. One is in terms of the pipeline that we are starting FY25 with, gives me a higher confidence. Number 2, several of our clients that I have met along with the leadership team and the sort of discussions we are having in different areas that I highlighted. Third, our strong delivery as well as technology capability. So I think if you look at all the assets are there, unless there is something external or the overall industry goes south, that's a different thing. I think we are well poised to deliver the growth, and these are some of the levers that give me the confidence. Our delivery is very strong, right? 80% of business coming through referenceability would have been possible if delivery was not strong.
Okay. So Kapil, why shy away not to give a quantitative growth guidance range as well, if we are looking for investment and sure about the growth targets and the aspiration and the achievements?
I think it's just like in the volatile industries that I mentioned to you, the volatility that we see. I think we have given the EBITDA guidance in the margin that we have given, and I think we will continue to operate in that range and we will deliver. Like aspirations, as some of your other colleagues asked, right? Our aspirations obviously are to deliver double-digit growth. Like in terms of what the number would be, I'd rather not say at this stage, and we will continue as and when we get greater visibility, we will keep you posted.
Okay, just last few things. During Gen AI times, there is a possibility that the industry may foresee some amount of cannibalization pressure or a pricing pressure. So during that time, to do an incremental investment could be also slightly risky. Is there a way to churn the investment rather than look for an incremental investment? So how are we defending if Gen AI after a couple of years leads to additional pressure on the margins?
So I think, Sandeep, in terms of, in fact, that from a strategic point of view, if let's say we were to envisage that threat and not as an opportunity, then you have to invest today so as to stay relevant, so that when it happens, you have brought in more predictability, more new clients, new engines of growth. I've already working well on the cross-sell engine, white spaces in existing clients. So that I think will help us de-risk the impact of Gen AI. We are also doubling down in terms of enabling our teams on Gen AI. We are, like I mentioned, on all our productized services, we are bringing in Gen AI capability. I think one of the questions you asked was on the alliances, which are alliances we are looking at. We'll be able to come and tell you, like in terms of technology companies, which are the alliances, wherever we are doing ops. As and when we structure the alliances, we will come and give you the visibility and highlight. At this stage, I'd rather not give like this is the company, this is the company, this is the company, because this is confidential and we are in some discussion. So as and when it happens, we'll come and inform.
Okay, I have more. I will come in the follow-up. Thanks. All the best.
Thank you.
Thank you, Sandeep. Next question comes from the line of Mihir Manohar. He is from Carnelian Asset Management. Please go ahead.
Hello. Yeah, hi. Am I audible?
Yes.
Yeah, sure. First of all, I mean, there is some echo at your end. I mean, I don't know. I am not able to hear it clearly. Maybe what is it, the situation for other participants? Okay, I will go through the question. I mean, I just wanted to understand, I mean, are we entering into new service lines in the existing verticals itself, or this is like an investment per se? The 400 basis points that we have quantified, is it going to be completely investment, or we are going to enter into new service lines which inherently will have lesser gross margins? Just wanted to have an understanding around that, because once the margins come down by 400 basis points, I mean, how to understand the recovery going ahead, that becomes very important.
So, like I said, we will look at building capabilities in adjacent areas, not new service lines. Number one, because we feel that the productized service offerings that we have, they are enough headroom within the industry segments we service and the existing set of clients that we have. So that answers your first question. In terms of margin, in terms of we are investing in hunting, as I mentioned to you, sales and hunting, which will help us gain larger market share as well as bringing more leads. And then we will invest in building adjacent capabilities. So that's where we are, and as and when we have more visibility, we will continue to provide you the visibility. At this stage, we are saying we'll operate between 24 to 28%. I know you guys are saying, you guys are assuming that we will be at 24%, which I think gives us only headroom to deliver better than what you are expecting.
That's interesting. Sure. Correct. So, I mean, are we looking at new, if you can throw light, is it, I mean, you also mentioned that if there would be some deals which require margins to be compromised, what extent of compromise on margins would be there because of such large deals which could come in?
I have an answer to that question. I think it's like, as I said, right, having done this in this business, this is a call collectively we will have to take as to what is right for the client, shareholders, employees, and then make a collective call, and that's a strategic decision at that point in time to say there's no stated guidance, we'll take the deal at this margin or we'll take the deal at this negative margin, or this is the kitty that we have created for going and buying deals. It depends upon the deal, the client context, strategic nature of the deal, the client, and many factors that go in it.
Sure. Fairly. Just lastly, I mean, I agree this would be once again the same question, but any indication around growth, any expectations around growth would be really helpful.
I think we are striving for double-digit growth is all I can say.
Sure.
And like I said, our starting pipeline is robust. That gives us the confidence. That's what is giving me the confidence. I think either you or one of your colleagues that asked this question.
Sure. Yeah. That's it from my side. Yeah. Thank you.
Thank you, Mihir. Next question comes from the line of Abhishek Shindadkar. He's from InCred Equities. Abhishek, please go ahead.
Yeah, hi. I hope you can hear me.
Yes.
Okay. I am going to ask the questions asked by the previous participants, but gonna change it or flip it. So are you trying to say that it is difficult to win in the market with the current margin profile we have, and that is why we have to let go some margins as a form of investments to win business?
That's not what I said. I'm saying that we need more sales bandwidth and hunting bandwidth to go and get a larger share of the market. Selectively, if there are deals that we have to take and they are strategic in nature and that meet our aspirations of growth, margin, shareholders' expectation, employees' expectation, and we are able to deliver to the clients, we will make selective calls to build new business.
Got it. That is helpful. Thank you for taking my question.
Thank you.
Thank you, Abhishek. Next question comes from the line of V.P. Rajesh. He's from Banyan Capital. Please go ahead.
Thanks, Asha. So most of my questions have been answered. Just two questions. This particular quarter, your revenue contribution from the top 10 client is higher than in the previous quarter and the previous year as well, same quarter. So any commentary about that in terms of, are you just focusing on winning more business from top 10, or something happened with the rest of the client base? Just trying to understand if this is sort of the new trend line.
So if you remember, we had this client which went away in persona, and that was not a top 10 client, it was 1.5 people, so fairly sizable. So when a client outside the top 10 drops out, obviously the concentration of the top 10 will go up. So that is one reason. The second reason is also that at least in this quarter, and if I look at the year in total, our growth with the top 10 clients has been actually quite faster, which gives us reason to believe that this is why we keep saying that there is enough headroom with existing clients for us to grow.
Okay. And my second question was about the buyback. Are the promoters going to participate in that? What's the guidance on that front?
Yes.
Okay. Thank you and all the best.
Thank you, Vicky. Next question is a follow-up question from Dipesh Mehta. Dipesh, please go ahead.
Yeah, thanks for the follow-up opportunity. A couple of questions. First, about the assumption, let's say, which we have made for lower end of the margin range and upper end, if you can give some sense, 24 to 28 range, what can lead to us to closer to 24 and what can drive it to 28, if you can give some sense. Second question is about we indicated about revenue growth top quarter. Can we say the same thing for absolute EBITDA growth? We will be among the absolute top quadrant in over 4-year period, considering margin reset, which we are expecting in year one. Third question is about the data related. If I look emerging client, this quarter it is negative even on YY basis. So if you can give some sense about what is playing out and how you expect it to change. I understand partly it can be because of digital business, but quantum wise it appears to be much sharp. So if you can give some sense. And last is about the advisory relationship, which you said we intend to expand presence into building partnership, alliances kind of thing, and as well as build a relationship with advisory firms. So if you can give some more details around it. Thank you.
Right. So I take the question on emerging clients. Actually, if you look at the count of clients in 0.5 buckets, so there has been movement year on year between the 3 buckets, but overall the count is 5. If you look at the revenue that we have earned.
Srini, sorry to interrupt. Your voice is breaking. We can't hear you clearly.
Oh. Is it better?
Yeah, much better.
Okay. So if you look at the clients that we report in each of our buckets, 0 to 5, $500,000, $1 million, 1 to 3, and 3 plus. The total clients in all of these, the clients in total in these buckets have gone up year on year. If you look at the revenue that we've been able to generate from in these buckets. So despite the decline that you see in the 1, 2, 3 bucket, actually the total revenue also has, each of these buckets has grown year to year. So the focus has been on strengthening what we already have in the 0 to 0.5 bucket plus, and then sort of try and weed out the clients who are not performing for us. So that is what we're trying to do here. The second question you had was on how we arrived at 24 to 28 and what assumptions went in. So broadly, I think we're looking at what investments we need to make in each area. What would be the cost of those investments? What would be the timing of those investments? And what would be the optimistic, likely, pessimistic kind of results of those investments? And in each of these three scenarios, how would the margin look like? And that's how we have come up with this range. You had one question on advisory.
So analyst and advisory channels we will build. Like I said, specific to alliances, I'd not give the names at this stage. I think when we tie up and build those partnerships, we will come and let you know in the subsequent earnings call. The intent would be again where, let's say, if you are doing ops work or digital marketing work, would we look at technology partnerships or alliances is what we will focus on. In terms of analyst and advisory channel that we will leverage, which I said we have not done in the past, is something that we are working with some of the leading analyst advisory firms, and we will see as and when they evaluate our capabilities, credentials, as and when they get them.
I think one question is unanswered. That is, absolute EBITDA growth will be among top quartile.
Sorry, what is the question? Absolute EBITDA growth.
No, so we indicated about revenue to be among top quartile over 4-year strategy period. Whether it holds true for even EBITDA.
Whether it holds true for EBITDA also. Whether EBITDA will also be in the top quartile.
The dollar EBITDA.
Yes, absolutely. No, we said we would be in the top quartile of both growth as well as EBITDA margins. I think that's what we said on the slide. Unless, but that's our intent. Yes, we will be in the top quartile of both growth and margin.
No, so there is a difference. What I'm asking is absolute EBITDA growth. I understand margin because we are already way above others. Even after correction, we will be above it. But absolute EBITDA growth has implication because of the margin reset which will happen.
Yes, so I think I will need to get back to you after checking the numbers. So first year, we can definitely assume that it will be lower than the revenue growth. And then years 2 to 4, I will get back to you.
Understand. Thank you.
Thank you, Dipesh. Next question comes from the line of Nitish Rege. He's from Quiz Capital. Nitish, please go ahead. Nitish, you need to unmute.
Yeah. Hi. Thank you for the opportunity. So as an investor, how do we think about growth? Earlier, we used to say that we will focus on absolute profit growth, and will we still grow profits on an absolute basis despite this margin guidance of a 400 basis point contraction? I'm struggling to think about how are we thinking on growth here.
So yes, that. Oh, go ahead. Yes, that is so for us, I think we stated in the past.
Sorry, I can't. It's not audible for me.
Yeah.
So I think thanks. Absolutely, the focus will be on driving both top line and bottom line growth. There's no fun in just growing the top line. I think we are not just working to grow top line. So yes, the focus will continue to deliver both top line and bottom line growth. We are giving you the margin range, but definitely there will be absolute EBITDA growth as well as EPS growth as well.
This is for FY25 also, right?
Yes.
Okay. Thank you. That's all from my side.
Thank you, Nitish. Next question comes from the line of Chirag Shah. Chirag, please go ahead and please mention the firm's name from where you are. Thank you. Chirag, I have
Hi, yeah, thanks for this opportunity. Chirag from White Pine. So three questions interrelated. One, at what point of this 4-year period you would relook at your margin guidance? That is one. Second, are you making a statement that the historical guidance of 20 to 32% is behind, and even if you look for an upgrade in margin guidance, it would be lower than that? Why I'm saying this, if I look at your last 10, 12, 15-year history, we started with upwards of 35% margins, then we went as low as closer to 20%, and now where we are. So business has seen a lot of changes over the years. So is there a big change that you are foreseeing for next 3-5 years, and hence the margin guidance which we had in the past is not relevant? So if you can just highlight this too, then I'll come back to the third question.
So the guidance on EBITDA of 24 to 28 is for year one. And every year we will come back and let you know if that range changes. Regarding the second question on 28 to 32, is it behind us? I'm actually unable to comment. It really depends on the growth that we are able to achieve. And whether we need to pump in fresh investments year after year to be able to sustain that. So I think, again, we'll probably come back to you in 6 months or 12 months and give you a better thoughtful answer.
Okay, just a follow-up on this. So if I look at last 5 years, a broader picture, your revenue was up by 15% and your profit was up by 18-20% range, depending upon how you look at it. Okay, now how should we look at these two matrices? That is, I think, what is the basic question that we are all boiling down to. Whether this 15-18% profit growth is what you are aspiring, or you are indicating that given the investment phase you are looking at, this 4-year CAGR or a 5-year CAGR could be lower than that. I think so. This is where the crux of the question is.
So I think all our commentary for now regarding EBITDA is year one only, and therefore by extension for profit also is for year one.
Okay.
And we really have to see how well the investments play out before obviously we have some plan in mind, and we have some idea of what this will look like over a 3-4 year period, but we'd like to see how it pans out and then talk about what the implications or what the outlook for the next further 3-year period is.
Okay. And if case Kapil wants to comment on this 28-32% margin range which was indicated, which was valid for a particular business period, are business dynamics changing that range is kind of not relevant at all, or how do you look at it?
So I think it's the reason we have given the guidance. What we have given is not a function of change in business dynamics or client sentiment or our relevance or anything of that. It's purely a function of investing ahead of the curve in sales and marketing and capability build, which we will continue to do, and we will continue to monitor the effectiveness of those investments on a real-time basis with strong governance process that we have made. Right now, we have given you the visibility for year one, which is for FY25. As and when we get more visibility, we will come and provide you that visibility. If not earlier, then we will give you as when we disclose the FY26 and FY27 and FY28. Having said that, we are also saying that we will be in the top quadrant of our industry growth and margins. Right? Because we are operating in a competitive market, we are operating in an industry. So we are saying we will continue to maintain our pole position on both growth as well as market.
Great, this answers the question. Thank you very much, and all the best.
Thank you, Chirag. Next question comes from the Veer Manwar. He is from Pioneer. Please go ahead.
Yeah, hi. Thanks for giving the follow-up. Sir, I mean, the 400 basis points that we have quantified, if you can split that between capabilities and building of sales and development, sales and business people, that will be helpful. And, you know, since given the fact that we are building a business development team, I mean, what kind of expectations are we going to have from him at the overall company level, on the growth side? That will be because, you know, just wanted to understand what is the expectations around when we are building a business development team, that will be helpful. And just a clarification, I think you mentioned that even in absolute EBITDA and absolute profit, so the absolute profit is 550 crores FY24. You are still looking in FY25, the absolute profit to grow. So what you essentially are saying is that the growth will offset the EBITDA cut which is happening, and we will still report profit growth. Is that the understanding correct?
Yes,
That is correct.
that's correct.
Okay, sure.
To your question, which is, I mean, we do not at this point want to.
Oh, sorry, Srini, I'm not able to hear you. I think there is echo which is.
See, the split between what we are investing in sales, capability, infrastructure, and other things, I think it's difficult to give that, like I've been saying, and I said confidently, you asked that will we report the increase in the bottom line profit, despite the margin guidance we have given, and I said yes. It's a real-time business, so depending upon the situation, the market needs and demands, we will continue to invest and build capabilities as well as on the sales engine.
Sure, understood. So that's roughly $10 to $12 million. I mean, any quantification as to, let's say, what number of people are we looking to hire in these geographies? Is it like we want to build a 10 people sales team, 20 people sales team, some indication around that?
I think it's not, see, the point is, it's not like we have said, okay, we'll build 20 people sales team and let's go and hire 20. You understand what I'm saying? We'll have to also see what is the return I'm getting on this team that we are building. We will also see what is the market sentiment, what is the market environment. Like I said, any sales investment that we make will take 6 to 9 months to yield results. And we will continue to monitor it on real-time basis. That's what we will continue. In terms of leave it to the management team and the executive committee to just make some of those decisions. At this stage, I think we have provided the guidance that we have visibility on.
Sure. That's really helpful here. Thank you very much.
Thank you, Meet. That was the last question for the day. Now I will hand over the call to PD for his closing remark.
So everybody, thank you so much for joining our call today. Appreciate you making the time, slightly longer session today than we usually have. Also, Anjan and I wanted to take this opportunity to thank you for the support that we have received from all of you over the years. It's been almost 15 plus years, that we've had the privilege of enjoying your support. With Kapil and the team taking on the reins of executive management, we feel confident that it's a massive upgrade on the previous management team, and we're in for an exciting ride. So from the next quarter onwards, the aim is for Kapil and Srini to lead these calls. We will, of course, be involved with the company with our ownership stake on the board, but we feel it's no longer appropriate for us to join these calls going forward. So wanted to take this opportunity once again to thank you all for your support, and I'm sure you all will give Kapil the same support and guidance and benefit of your counsel over time. I don't know if Anjan wants to add a few words before we sign off today.
No, PD, I think you've said things very well. I guess the only thing I'll remind people and the investor community is that ultimately it's a long game, and we should just play for the long game.
Thank you.
Thank you, PD. Thank you, Anjan, and thank you for giving the opportunity. Thank you very much.
Thank you, everyone. Bye and have a nice week.
Thank you.
And don't forget to vote.